All right, guys, good morning. Happy Thursday, May 2nd. Welcome back to the show. We are just about to go live with the Cinemark earnings call. Let me pull that up and see if we still have on-hold music. Hang on one second. Still got music, so they're going to be starting here any second. Cinemark did have a beat today, both on revenues and earnings. 19 cents positive EPS. What was the earnings? 576 million, I think, versus the revenue, 576 million versus 560 expected. $25 million net income for Q1. And what we want to hear today is their state of the industry and their expectations for the rest of this year, 2025 and 2026. Still got a couple minutes of on-hold music. They should be starting here any minute now. 7:30 Central, 8:30 Eastern. Cheers. Hope you got your coffee ready. It's going to be a long day, guys.
Inc. First
All right,
quarter
here we
2024 earnings conference call.
I'm going to mute my mic while we're listening in,
in
but I will be able to
mode.
read your chat and
Brief
respond to you there.
question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Ms. Chanda Brasher, Senior Vice President, Investor Relations. Thank you, Ms. Brasher. You may begin.
Good morning, everyone. I would like to welcome you to Cinemark Holding, Inc.'s first quarter 2024 earnings release conference call, hosted by Sean Gamble, President and Chief Executive Officer, and Melissa Thomas, Chief Financial Officer. Before we begin, I would like to remind everyone that statements or comments made on this conference call may be forward-looking statements. Forward-looking statements may include, but are not necessarily limited to, financial projections or other statements of the company's plans, objectives, expectations, or intentions. These matters involve certain risks and uncertainties. The company's actual results may materially differ from forward-looking projections due to a variety of factors. Information concerning the factors that could cause results to differ materially is contained in the company's most recently filed 10-K. Also, today's call may include non-GAAP financial measures. A reconciliation of these non-GAAP financial measures to the most directly comparable GAAP financial measures can be found in the company's most recently filed earnings release, 10-Q, and on the company's website at ir.cinemark.com. With that, I would now like to turn the call over to Sean Gamble.
Thank you, Chanda, and good morning, everyone. We appreciate you joining us today to discuss our first quarter 2024 results. Over the past 3 years, the theatrical exhibition industry has seen meaningful year-over-year increases in attendance and box office as film volume has been rebounding following the shutdown of movie making during the pandemic. And, as we indicated last quarter, while this year will likely experience a dip in that recovery trajectory due to over 6 months of Hollywood strikes last year that again disrupted film production, 2024 kicked off to a better-than-expected start. First quarter North American industry box office declined only modestly versus 2023 on account of a wide range of films that delivered outsized results. Examples include sci-fi sensation Dune Part 2 that outgrossed its first installment by more than 2.5 times with over $275 million of domestic box office. Animated hit Kung Fu Panda 4, which became the second biggest installment in its franchise history with over $180 million domestically and more than $500 million worldwide. Biopic Bob Marley, One Love, which captivated audiences and generated nearly $100 million of domestic box office. Musical comedy Mean Girls and action thriller The Beekeeper, which each delivered close to $70 million domestically. And mega adventure Godzilla x Kong: The New Empire that opened to a monstrous $80 million in North America at the end of the quarter and has since delivered over $500 million worldwide. The first quarter also benefited from strong continued playthrough of December's whimsical family spectacle Wonka, which has now exceeded $215 million domestically and nearly $415 million globally, as well as Anyone But You, that proved audiences are still craving romantic comedies in theaters, having generated close to $90 million of domestic box office over its impressive run. Furthermore, we continued to witness strength of non-traditional content during the quarter, such as the successful releases of Cabrini and the complete fourth season of faith-based series The Chosen. The solid results of all these diversified titles once again provide strong, further validation that consumer enthusiasm for experiencing compelling content in an elevated, cinematic theatrical setting remains vibrant. We certainly experienced that enthusiasm within our Cinemark theaters during the first quarter as we entertained nearly 40 million guests across our global circuit with results that once again outpaced the industry. Relative to 2019, our admissions recovery continued to sizably exceed that of our industry by 700 basis points domestically and 600 basis points internationally. To that end, we also continued to maintain the most significant market share gains compared to pre-pandemic results of all major exhibitors. While Melissa will cover our financials in greater detail in a moment, during the first quarter, we generated nearly $580 million of total revenue, more than $70 million of adjusted EBITDA, and a healthy 12% adjusted EBITDA margin. These results once again demonstrate our team's resilience and outstanding ability to skillfully navigate a dynamic operating environment pressured by strike-induced headwinds. Yesterday, we also successfully retired another $150 million of our COVID-related debt, given our sustained confidence in our team, financial position, and positive long-term outlook for our company and industry. That positive outlook was further reinforced a few weeks ago during CinemaCon, our industry's annual trade show event, as studios and filmmakers provided glimpses into their upcoming film lineups for the next year and a half. One key message that was emphasized again and again by studios during CinemaCon, as has been consistently conveyed to us during our one-on-one conversations, is the significant enhanced value that a theatrical release provides their films and their companies. As we've highlighted on previous earnings calls, the clear consensus is a theatrical release delivers unparalleled levels of promotional impact and quality perception, which strengthens consumer interest to see films, bolsters long-term recall value, and leads to elevated lifetime financial results throughout all distribution channels. It's also very important for consumers who want to experience these films on the big screen, as well as for attracting top-tier talent. In light of this context, as well as what has been further communicated by the studios with regard to their future film development plans, we continue to remain bullish about the resurgence of film volume over the coming years. Production is now fully up and running again following last year's strikes. New significant entrants like Amazon and Apple are meaningfully scaling into theatrical exhibition, and non-traditional content like concerts, faith-based films, multicultural titles, and anime is also growing. Along these lines, the major studios took the opportunity during CinemaCon to showcase an increased numbers of titles relative to prior years, and what they shared, both the quantity of films as well as the quality of materials presented, created a buzz of optimism that permeated the convention all week. A diverse range of highly anticipated films slated for the rest of this year appear primed to fully deliver, including a resurgence of family films like If, the Garfield movie, Inside Out 2, Despicable Me 4, Moana 2, and Mufasa the Lion King, action-adventure sagas such as Kingdom of the Planet of the Apes, Furiosa, Bad Boys Ride or Die, Twisters, Venom the Last Dance, and Gladiator 2, comedic thrill rides like The Fall Guy, Deadpool and Wolverine, Borderlands, Beetlejuice, Red 1, and Sonic the Hedgehog 3, suspense thrillers such as A Quiet Place Day 1, Alien Romulus, Joker 2, Speak No Evil, and Smile 2, and the fantastical world of Wicked Part 1. And next year's lineup is already coming together in a big way with a wide array of spectacle films that includes Wicked Part 2, Another Jurassic World, Superman Legacy, the next installment of Mission Impossible, a reboot of the Fantastic Four, Ballerina from the John Wick universe, a live-action version of How to Train Your Dragon, Captain America: A Brave New World, Snow White, Zootopia 2, Minecraft, Megan 2, Tron Ares, and of course, Avatar 3, whose prior installments represent the #1 and #3 biggest global films of all time. So again, based on strong, sustained consumer interest in moviegoing, numerous indicators that point to a continued resurgence of film volume, and the highly encouraging slate of upcoming titles on the horizon, we maintain a positive future outlook for theatrical exhibition and our company. And we believe that Cinemark, in particular, is uniquely positioned to prosper as we move forward on account of several key differentiators. To start, our consistent investment in maintaining and enhancing our theaters over time, which we have performed at sustained levels that significantly exceed our peers, has positioned our company with the largest collection of high-quality assets in our markets. In addition to a more favorable overall condition of our theaters, we have the highest penetration of luxury seat of the major operators, with almost 70% of our domestic circuit reclined. We have the best sight and sound technology and overall film presentation in the business, including 99.97% screen uptime. We have the #1 private label premium large format in the world with our XD auditoriums, as well as the largest footprint of D-Box motion seats. And we now offer enhanced food and beverage menus in more than 80% of our U.S. theaters. We also have a distinctive global footprint across the U.S. and Central and South America, with a concentration in both suburban and Latin markets that have strong moviegoing cultures, which tend to over-index in theater visitation frequency. With one of the highest market shares in North America, as well as the highest share across our Latin American region, our global footprint also provides valuable scale. Furthermore, it provides attractive diversification across 42 states and 14 countries, beneficial best practice sharing, and access to varied pockets of growth in underpenetrated markets. Beyond the quality of our assets and our favorable geographic profile, we also have a solid financial position with a healthy balance sheet, industry-leading adjusted EBITDA margins and cash flow generation, and results that consistently outperform our industry. Our disciplined and balanced approach toward capital allocation over the years has positioned our company with an outsized advantage to both effectively navigate periods of reduced film volume, as well as actively capitalize on market opportunities as they materialize. Our solid financial position is further supported by our advanced operating capabilities. These capabilities are the byproduct of deep experience, domain expertise, and skill of our sensational global team, as well as years of deploying strategic initiatives. Examples include our heightened levels of customer service that consistently earn high satisfaction ratings from nearly 95% of our guests in our domestic surveys, sophisticated social and digital marketing platforms and tools that deliver billions of media impressions annually, driving increased film awareness and demand to visit Cinemark, and planning and execution rigor that has a consistent track record of optimizing showtimes and staffing, fine-tuning operating hours theater by theater based on fluctuating weekly demand, and driving efficiencies to help offset varied inflationary and supply chain-oriented headwinds. Our adept operating abilities and consumer-minded actions have also helped us to develop a loyal and extensive consumer base. We have over 21 million members in our global loyalty programs, and in the U.S. alone, Movie Club, our paid subscription tier, now accounts for 25% of our domestic box office. These members are frequent and dedicated Cinemark moviegoers, as well as our most satisfied guests. Moreover, our marketing reach extends to a total addressable customer base of nearly 30 million consumers and continues to grow. Finally, we are also well-positioned to drive incremental value creation on account of the numerous levers we have that go above and beyond our industry's continued recovery and our singular competitive advantages. From continuing to extend premium amenities more broadly across our circuit, to enhancing our food, beverage, and merchandise offerings, as well as distribution methods even further, to taking our pricing sophistication to the next level while executing a wide range of additional productivity initiatives, to further optimizing our circuit, including adding attractive new assets while addressing lower performing properties. The opportunities before us to drive incremental growth and prosperity that are fully within our control are plentiful. Those opportunities, combined with the positive direction our industry is headed, as well as our advantage market position, underpin our optimism about the future of Cinemark and our ability to create meaningful, long-term value for our shareholders. I'll now turn the call over to Melissa for a deeper look at our first quarter financials. Melissa?
Thank you, Sean. Good morning, everyone, and thank you for joining the call today. We were pleased that the first quarter box office surpassed our expectations. Our team once again demonstrated our agility in the fluid environment and achieved healthy operating and financial outcomes by capitalizing on the box office and diligently executing our strategic initiatives. Globally, we welcomed 40 million guests to our theaters and generated $579.2 million of worldwide revenue in the first quarter. We delivered $70.7 million of adjusted EBITDA, yielding a solid adjusted EBITDA margin of 12.2%, despite the pressure on operating leverage given the attendance decline due to the impact of the Hollywood strikes. Domestically, we entertained 23.6 million moviegoers in the first quarter and maintained strong market share. We generated $231.8 million in admissions revenue, and we grew our average ticket price 1% year over year to $9.82. The growth in average ticket price was driven by our strategic pricing initiatives, partially offset by ticket type mix with more family content in the first quarter of this year, as well as format mix due to the lapping of strong 3D penetration on Avatar from the prior year period. We generated $178.6 million of domestic concession revenue, and our U.S. concession per cap achieved a first quarter record of $7.57. Our concession per cap grew 2% in the quarter, fueled primarily by strategic and inflationary pricing measures and a shift in product mix towards higher price concession items, partially offset by lower incidence rates due to film content. Other revenue was $46.6 million, down 2% year over year, primarily due to the decline in attendance. Collectively, our domestic segment generated $457 million of total revenue and $49.1 million of adjusted EBITDA, yielding an adjusted EBITDA margin of 10.7%, reflecting the relatively fixed nature of our domestic cost base. Shifting to our international segment, we hosted 16.1 million guests during the quarter, a decline of 9% versus the first quarter of 2023, as the film slate did not resonate as well in the Latin American region year over year, though we did benefit from an increase in local content in Brazil. Similar to the U.S., we maintained strong market share across the region. As reported, our Latin American operations delivered $58 million of admissions revenue, $45.6 million of concessions revenue, and $18.6 million of other revenue. Altogether, we generated $122.2 million of total international revenue and $21.6 million of adjusted EBITDA, yielding a 17.7% adjusted EBITDA margin. Foreign currency devaluation, particularly with respect to the Argentinian peso, resulted in a year-over-year headwind to international adjusted EBITDA in the quarter that was largely offset by inflationary dynamics. Our seasoned and knowledgeable local teams continue to skillfully maneuver through the fluid economic and political environment in the region. Turning to our global expenses, film rental and advertising expense was 53.2% of admissions revenue, down 40 basis points year over year due to a lower concentration of box office and the mix of films during the quarter, partially offset by higher marketing spend. As I mentioned on our earnings call last year, industry box office in the first quarter of 2023 meaningfully exceeded our expectations, resulting in marketing expense as a percentage of admissions revenue that was somewhat lower than we had planned, creating a tougher comparison. Concession costs as a percent of concession revenue were 19.6%, up 110 basis points compared with the first quarter of 2023, driven by ongoing inflationary pressures on certain core concession items, as well as a shift in product mix towards lower margin products, such as movie-themed merchandise, Strategic pricing measures partially offset these impacts. Global salaries and wages were $86.9 million, relatively in line with the first quarter of 2023. As a percent of total revenue, salaries and wages increased 90 basis points, primarily due to reduced operating leverage associated with the decline in attendance, wage rate pressure, and expanded operating hours. Benefits from our ongoing focus on labor management drove a partial offset. Facility lease expense was $77.3 million, a modest decline of 3% year-over-year, primarily due to theater closures. As a percent of total revenue, facility lease expense increased 30 basis points. Utilities and other expense was $100.4 million, down 3% from the first quarter of 2023, primarily driven by variable costs that declined with attendance and foreign currency impacts, partially offset by inflationary pressures. As a percent of total revenue, utilities and other increased 30 basis points. G&A was $48.9 million in the first quarter, an increase of 5% year-over-year, primarily due to wage and benefit inflation, one-time severance costs, and higher share-based compensation, partially offset by lower professional fees and the impact of foreign currency fluctuations. We continue to exercise prudence in our discretionary spending and staffing decisions, maintaining headcount below 2019 levels. As a percent of total revenue, G&A increased 80 basis points. Globally, we generated net income attributable to Cinemark Holdings, Inc. of $24.8 million in the first quarter, resulting in earnings per share of 19 cents. Net income for the quarter included a $27.7 million tax benefit, primarily due to the release of valuation allowances in certain foreign jurisdictions. Moving to the balance sheet, we ended the quarter with a strong cash position, with $789 million of cash on hand. As expected, our free cash flow was negative $46 million for the quarter, given the softer box office environment, the timing of our semi-annual interest payments, seasonal working capital headwinds, and our ongoing investment in our circuit. In the near term, we remain focused on further strengthening our balance sheet while deploying capital towards strategic investments that position the company well over the long term. To that end, yesterday, we used cash on hand to redeem the remaining $150 million of our 8.75% senior secured notes at par, reflecting our confidence in our company's and the industry's recovery. Furthermore, we invested $23 million in capital expenditures to further enhance our global circuit. Looking ahead, we continue to anticipate deploying $150 million this year towards capital expenditures, aligning with our commitment to prudent financial management. At the end of the quarter, our net leverage ratio stood at 2.8 times for the trailing 12 months, which is at the high end of our target range of 2 to 3 times. While our objective is to sustain this leverage ratio within our target range, we may face some pressure this year due to the Hollywood strike impacts. I would like to reiterate that at this juncture, our capital allocation decisions are prioritizing a dual focus: refortifying our balance sheet and strategically positioning ourselves for long-term success. In closing, as we face complexities associated with the Hollywood strikes, our commitment to sound operating and financial practices remains steadfast. At the same time, as Sean highlighted, we are laser-focused on maintaining our distinctive market position and further advancing our company, which gives us optimism regarding our future prospects and the value we can provide to our shareholders. Operator, that concludes our prepared remarks, and we would now like to open up the line for questions.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your questions from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. The first question comes from the line of Eric Handler with Roth MKM. Please go ahead.
Good morning, and thanks for the question. Sean, we've seen a number of companies this earnings season talk about the consumer being more conservative with or selective with their spending decisions. I'm curious, are you seeing anything notable in terms of how they purchase tickets or food and beverage decisions that maybe suggest there's some selectiveness going on here too?
Good morning, Eric. Thanks for the question. It's a good question. I'd say, interestingly, to date, very consistent with history, we have not seen a significant impact from the macro economy on our business. Consumers, when the movies are in our theaters, we've continued to see consumers coming out. I mean, I think we mentioned that in the prepared remarks, just in terms of the number of films that have delivered above expectations. And that plays through to choices to upgrade to premium formats. It plays through to concession purchases. As we mentioned, we had another record first quarter per cap this quarter. So we haven't seen that bleed through. It's similar to, as I mentioned, recessionary environments of the past, where our industry has grown in 6 of the past 8 major recessions in North America. Going to the movies remains an affordable form of entertainment, while consumers may scale back in other things that they may otherwise go to. It's a localized, affordable means of entertaining themselves, and they still tend to select, to indulge when they come to theaters, and we've continued to see that in this current environment.
Great, and then just the follow up. From what I've seen in your press release, there really isn't much of a backlog at this point with new build theaters. Are you seeing anything change in the market that maybe could allow you to expand at beyond what you're currently planning?
Sure. Well, I think there's probably twofold. One, I think much like the whole of the industry, during the course of the pandemic, our development process was more or less put on hold. We have reactivated that development pipeline process, so we're out there kind of scouting, looking at sites. So there's a bit of a delay on account of that. And then beyond that, as we've talked about, we're still in that mode of just refortifying our balance sheet and being tempered in the amount of CapEx we're deploying as our cash flow continues to recover. So I think those two things are a bit of regulators over just the speed of new build activity, but there are still plenty of markets where we see opportunities, and I think some of that will start to ramp to a certain degree over the coming years. It's just going to take a little bit of time.
Thank you.
Thanks, Eric.
Thank you. Next question comes from the line of David Karnovsky with JP Morgan. Please go ahead.
Hi, thank you. Sean, wanted to see if you could expand a bit more on your conversations in CinemaCon. What are you hearing from legacy studios in terms of output? Is there anything incremental to share regarding some of the streamers? And then, with Amazon, we've seen them achieve some success recently with exclusive streaming films. Does that create any concern from your end about their output ramping over time? And for Melissa, just your staffing costs were nearly flat year over year. Wanted to see if you could just speak a bit more to the initiatives you're deploying to control expenses there, and how should we think about the rest of the year, kind of just given natural labor inflation and likely improvement in film supply by Q4?
Sure. All right. Well, thanks for the questions. Starting with CinemaCon, I'd say the overall feeling coming out of CinemaCon was definitely a very positive one. I think so it's interesting to get some exposure to the materials that are up and coming, and by and large, I think everyone was really positive about what they saw. Things look extremely promising. As I mentioned, to just the number of titles that were showcased were also to a greater degree. How that all plays through to future volume, both what we heard during CinemaCon and also what we continue to hear as we speak directly with our studio partners, is one of a focus on continuing to replenish their production. They're building their slates back in many respects towards where they were pre-pandemic. In certain cases, looking to go beyond that, but it's just going to take some time. Obviously, they were in the process of ramping that back post-pandemic. and then the strikes just put a little hiccup in that. So that's just prolonged things a bit further. But on the whole, we remain very optimistic that in the coming years we could see volume return back to, close to, if not exceed, pre-pandemic levels. Specific to your question on Amazon, look, we have very direct conversations. I think they're really bullish about theatrical opportunities. They're continuing to build towards that. They've got a number of films already slated this year. I think they're looking at 25 as kind of their first big major film slate in theatrical. That doesn't mean that they're gonna walk away from direct to platform films. I mean, we've seen that forever in this industry, where studios will make, HBO would make direct for HBO movies in the past, and there'd be direct to video films. So we certainly expect there will continue to be direct to streaming films. It's those movies that have, a certain degree of higher scale and potential that are the ones that we will see coming to theaters. And we know that Amazon, at least what they're sharing with us, remains very committed to continuing to build into the space.
And then, David, on the labor front, so we do continue to scale our labor hours up and down based on projected attendance levels that we're seeing. And we are working on a range of initiatives to drive further labor productivity. So a couple of examples for that would be continuing to right-size our staffing at the wings, so opening and closing, being even more nimble between slow and peak periods with a focus on our most profitable service hours, optimizing operating hours and scheduling for expanded food and beverage offerings. Those are just some of the ways that we're looking to drive efficiencies. With respect to salaries and wages, more broadly, it is reasonable to assume going forward that we'll continue to flex our labor hours based on anticipated attendance levels, albeit at a rate that is less than the change in attendance. I will say on the wage rate side, we do continue to face some pressure there. Now, fortunately, what we're seeing now is more in line with pre-pandemic increases. And then, as I mentioned, we do expect to continue to see some productivity benefits as we lean in there. The one call I would make, though, in 2024 in particular, especially in the first half of the year, we do expect to be more impacted by minimum staffing levels, just given the reduction in content volume is more concentrated in that period this year. But overarchingly, we're leaning into data, assessing our profitability on a per theater, per hour basis to determine operating hours and our corresponding staffing requirements. And we'll continue to balance our revenue-generating opportunities with cost-mitigating initiatives.
Thank you.
Thanks, David.
Thank you. Next question comes from the line of Ben Swinburne with Morgan Stanley. Please go ahead.
Good morning. Two questions really around some debates, I think, on your business and the stock. Your market share gains have persisted now for a while, coming out of the pandemic, which, as you know, and I guess one question I'd be curious to hear about is just the role that your loyalty programs you think play in driving share. I mean, I thought the slide in the deck that you have is interesting. You've got, 1 million plus people in Movie Club, but 20 million plus in a rewards program. I guess the question is, do these have a measurable, tangible benefit to your share and returns that you could share with us? And then secondly is around kind of capital allocation. I know leverage ticked up as expected. I'm just wondering, Sean, if you could talk about how you guys look at M&A. How do you think about valuing assets out there relative to your own stock? How do you think about deploying capital in M&A relative to resuming the dividend? I think it'd be helpful to hear your approach to those trade-offs as you guys move through this year. Thank you.
Excellent. Well, thanks for the questions, Ben. To start with market share, we certainly believe that our loyalty programs play a part in supporting our market share. It's difficult to fully slice that up in terms of how much of that is attributable just to the loyalty programs versus to some of our showtime planning efforts, as well as just the marketing actions we do in general to try to stimulate demand in coming to Cinemark. Like there's a whole series of things, and just the overall service and experience that we try to provide in terms of our elevated levels of maintenance and just the overall experience we create. So it's tough to say that, but given that Movie Club now consistently represents about 25% of our box office, and those moviegoers tend to be our most satisfied moviegoers. I mean, they wind up having a strong affinity to coming to our theaters. And so it certainly is a component, we believe, of what we're seeing in the uptick in our share. We continue to look at ways that we can continue to pack value in that and utilize the data and that communication channel we have to create value for those guests, because we see them over-indexing in their degree of frequency, in their level of coming to Cinemark, and again, their overall satisfaction with regard to the experience they're having. Specific to M&A, look, M&A is certainly one of the prongs of potential growth we think about as we consider optimizing our footprint and growing overall. We do continue to target high-quality assets that we believe can deliver solid, assured returns over time. So we evaluate everything through that lens. We're not just looking to grow for growth's sake. We believe we've had a lot of success in being disciplined and balanced with regard to deploying capital and targeting those kinds of investments that really do have a high probability of success. So we've done well in that regard. I'd say in this marketplace right now, what we're seeing is there still is a little bit of distortion out there. It's a little bit complicated just due to a range of things. Clearly where the debt markets are right now, interest rates and costs of borrowing, expectations of sellers still are off in certain cases in terms of expectations of what their margins really are and what multiples should be. There's also that added layer of any particular type of company we might look at. What is the level of incremental investment that may need to go back into that business to get those assets in the right shape, depending on what levels of deferred maintenance there may have been over the past several years. So that also just plays into the calculus of all that. So it's something that we certainly look at all opportunities in the marketplace. We're optimistic that some of those opportunities could shake out over the next year or so based on the environment we're in, but we're going to continue to be very disciplined and balanced in our approach towards that.
And in terms of our near-term capital allocation priorities, I mentioned as we stated on the call that those do remain centered around strengthening balance sheet and making those right investments to position us well for the long term. Ultimately, our decisions, as Sean mentioned, are driven by returns. In terms of the dividend, though, we do believe our approach is prudent right now, maintaining conservatism around our cash, given the box office headwinds this year, coupled with the back-end weighting of the box office, which we do believe may pressure our net leverage ratio in the near term. All that said, though, dividends, a significant aspect of our capital allocation strategy prior to the pandemic, and will remain a key consideration for us going forward.
Great. Thank you both.
Thank you.
Thank you. Next question comes from the line of Robert Fishman with MoffettNathanson. Please go ahead.
Hi, good morning. One for Sean and then one for Melissa. Sean, maybe taking a different angle on the CinemaCon takeaways, I'm wondering how you characterize Cinemark's relationship with your studio partners, more as it relates to the recent or maybe even upcoming renewals around windowing strategies? And do you see an opportunity to improve film rental splits going forward? Maybe let's start there and I'll come back with my other one.
Sure. Well, I'd say overarchingly our relationships are very positive with our studio partners. Specific to windows, that there's clearly been quite a bit of evolution in the window throughout the pandemic and following up on the pandemic. I think with a lot of experimentation, there was clearly quite a bit of learning that an exclusive window definitely is something that creates more value for these film assets, particularly for the studios. It's the best way to fully gain that revenue opportunity in the theatrical space. It helps to create that bigger cultural moment. It helps to create more lift in downstream impact on all those subsequent channels. So that has clearly been tested and learned again, and is something we're seeing now by and large in the practice of windows. I would say one of the changes, which we actually view as a net positive, while the window reduced a bit coming out of the pandemic and has become more dynamic, what that has led to, in our view, is something that improves the risk equation for the studios. So in success, a movie can run long and they can extract more value out of the window. Whereas if a movie, they go for it and the movie just doesn't work, they've got an opportunity to get into the home quicker and manage their downside, which net is a good thing, especially as we're looking for more volume to come back through. So it's one of the things we look to as a positive that plays into that resurgence of volume. And the reality is, when movies aren't working, generally we're moving on to the other films that are working stronger to begin with. So it works collectively, both ways. And we think that can lead to the studios taking more risks on films like the mid-tier films and the romantic comedies and the raunchy comedies, some of the stuff that we haven't seen as much of as of late, because that was a tougher financial decision prior to the pandemic. So we're very positive on that. And I would say over the course of discussions, there has been economic consideration that has been factored into the equation with regard to some of the evolution of windows. So I think more on the go forward, it's just back to kind of that typical back and forth from any supplier customer relationship in terms of the splits. I wouldn't say there's any heightened degree of pressure or ease relative to the norm. It's that traditional relationship where sometimes one party is a little bit stronger and other times others, and things just kind of ebb and flow. And in the aggregate, the overall film rental rates tend to stay relatively stable.
Okay, great. Thank you, Sean. Melissa, if I can do a little bit more detailed follow-up on CapEx. Spending levels have hovered around 150 million range. You mentioned guidance again for this year coming out of the pandemic. But back in 2019, you were at an elevated 300 million level. And I understand that included the core maintenance spend in that 80 million range. But there was more significant spending levels around the new builds that you already touched on and these cash flow generating projects. So I'm just maybe a long way of asking, should we expect to see more investment in cash flow generating projects or anything else in the pipeline to call out to get back to more of an elevated level in 25 and beyond, even if it remains below 19 levels?
So thanks for the question, Robert. So we do believe our history of proactively maintaining and investing in our theaters is a key differentiator for the company. As you think about CapEx beyond 2024, I would expect us to maintain, again, a balanced and disciplined approach to our capital expenditures, but to ramp our CapEx levels up as the box office rebounds. While our peak CapEx years are behind us, from where I sit today, what I would say is, we expect to grow to around CapEx to grow to around 200 to 250 million annualized on a normalized basis. So that'll be contingent upon, obviously, the ROI generating opportunities that are available to us, but that 200 to 250 annually is where we think CapEx should shake out relative to that kind of 300 plus range that you saw peak at our peak years in the pandemic. And remember, that included kind of that heavy push for recliner penetration that's behind us largely at this stage. We would still expect around 80 to 100 million of that spend to be earmarked towards maintenance CapEx to maintain a high quality circuit. The remainder dedicated towards new builds and other theater enhancements, including laser projector conversions.
Great. Thank you both.
Thanks, Robert.
Thank you. Next question comes from the line of Omar Mejias with Wells Fargo. Please go ahead.
Good morning, guys. Thank you for taking my question. Sean, maybe on the market share performance, it was very impressive during the quarter, especially as the slate wasn't particularly favorable for your demographics. To the extent you can you parse out the impact from Dune 2 and PLF performance versus continued organic share gains? And maybe second for me, you recently extended your summer movie clubhouse program in response to strong consumer demand. Can you talk about the benefits of programs like this and any other opportunities that you have to maximize capacity utilization across your circuit during off-peak periods? Thank you.
Sure. Thanks for the questions, Omar. Specific to share, obviously we were very pleased with our results in the first quarter. And actually, there were several. We benefited in particular from a handful of outperforming titles. So films like Kung Fu Panda 4, Godzilla X Kong: A New Empire, and Bob Marley: One Love. Those films skewed very much in our favor during the course of the quarter, and I think were some of the drivers of our share. They more than offset, I would say, some of the headwinds. Dune 2 was, by the way, our biggest film of the quarter, but given it's a heavy sci-fi film, which often doesn't skew as much in our circuit, our share was a bit lower on that specific title. But collectively, all these other films, definitely helped to drive that. I'd say another benefit, in that it was a overall reduced box office environment due to the strikes. We also weren't coming up against capacity issues. Sometimes in those higher box office periods, you can only sell as many seats as you have. So that can also sometimes lead to a dampening of share a bit. We didn't have any of those issues over the course of the quarter, which allowed us to really fully maximize the upside potential on all of these titles. Programs, it's interesting you mentioned the Summer Movie Clubhouse, and we think it's a great program. Really, the goal of that program is to try to get younger families and younger audiences into the habit of moviegoing by giving them a very accessible price point on some legacy films. It really is a program that runs for a number of weeks. It's one day a week in the morning, so it's an early morning type of opportunity. So it can help with to a certain degree filling out that kind of maybe slower period on an early Wednesday morning. But I'd say that program in particular is really more designed towards trying to stimulate moviegoers of the future versus fill in other periods of lower capacity. We do run a number of other types of programs of bringing back repertory content, fan favorites, and things of that sort that we look to kind of sprinkle in to lower periods of volume and certain days of the week as a way to try to get a lift in during the course of the weekdays in particular in slower periods of business. So there are efforts like that we do pursue to try to do that.
Great, thank you.
Thanks, Omar. Appreciate it.
Thank you. Next question comes from the line of Chad Beynon with Macquarie. Please go ahead.
Hey, good morning. This is Aaron on for Chad. Thanks for taking our question. One more for you around CinemaCon. Was there anything you saw from a tech standpoint that you believe could enhance or change the experience for your moviegoers or help you from a productivity standpoint?
Think about that. There's all kinds of evolutions that are constantly happening in terms of new introductions of technology, both from a productivity standpoint as well as from a presentation standpoint. Obviously, Barco recently announced their new HDR kind of light steering projection capability. It's something that we've been talking to them about and working with them on for actually a number of years. So that's kind of out there, and that's something that has the potential. It's a new, even heightened level of laser projection. I mean, laser projection in and of itself takes the quality of light on screen to a new level. It actually has productivity elements baked into it as well because it doesn't consume as much energy. You don't have to change the bulbs as much. You don't have to maintain them as frequently. So those types of pieces of equipment lend themselves to productivity, and then the light steering component of that also is something that could be taking that to another level. So there are things like that that work. But yes, there's a range of things. I mean, even in food and beverage, new types of equipments, things like that could lead to productivity. I mean, not necessarily specific to CinemaCon, but obviously you see it in different places in the market with unattended retail and things of that sort, which could lead to some overall, labor productivity, depending on, as well as just revenue growth in pockets of theaters where you may be able to insert some of those things and drive incremental sales. So yeah, I would say that's something that our teams are constantly evaluating, and it goes well beyond Cinemark, just looking at what's coming to market in various pockets of our business, from presentation, from labor management, from food and beverage equipment and things of that sort, just to drive incremental productivity benefits and overall experiential opportunities.
That's great. And then just regarding concession per cap, so you just hit a domestic record in the U.S. for the first quarter. Are you seeing more engagement in terms of incidence of purchase, bigger basket size, or price increases? How would you break that down? Thanks.
I'll take that one, Aaron. So on the domestic per cap side, our per cap was up 2% year over year, and that was driven by strategic pricing actions to offset some of the inflationary cost pressures that we've been seeing, as well as a shift in product mix towards higher price items, merchandise being one example of that. That was partially offset by lower incidence rates due to the content mix in the quarter. So that's really the breakdown of the drivers there. As you think, though, about our per cap on a go-forward basis, we do continue to believe that we can moderately grow our concession per cap for full year 2024 domestically. We continue to lean into various initiatives to maximize our incidence rates, so mobile ordering adoption, self-service capabilities, modifying the flow of concession traffic, as well as leaning into enhanced food offerings, merchandise sales, and scaling third-party delivery. We also continue to look to find optimal pricing that will maximize our per caps while maintaining high incidence rates. But as you saw in the first quarter, our per cap will fluctuate ultimately quarter to quarter with film mix.
That's great. Thank you very much, and congrats on the quarter.
Thanks, Aaron. Appreciate it.
Thank you. Next question comes from the line of Mike Hickey with Benchmark. Please go ahead.
Hey, Sean, Melissa, Shanda. Good morning, guys. Great job on the quarter. Just two questions from us. Obviously, you don't forecast the box office, Sean, for obvious reasons, but given what you know, I guess, about Q2 and the rest of the year, and maybe just in terms of wide releases, do you feel like, obviously Q1 outperformed, do you feel like you can sort of build on the strength of Q1 sequentially through the remainder of the year, or any sort of, I guess, insight on phasing on the box office? It seems like Q2 would be higher than Q1, Q3 higher than Q2, Q4 higher than Q3. But curious what you think there, and then any updates, I guess, on wide release product in 25, how that would compare 24 and pre-pandemic. And then Melissa, not sure if you touched on this or not, but your concession margin domestically was sort of sub 81%. I think it's had about 3 quarters of sequential pressure here. Just curious what's driving that, and if you think this is sort of a low point in the quarter and you can sort of build back margin through the remainder of the year and medium term. Thanks, guys.
Sure. Thanks for the questions, Mike. It's specific, I guess, starting with this year. Yes, we saw a little bit of lift in the first quarter. There's been some title shifts, like we know, just like Karate Kid just moved out a year. So when we look at the totality of 2024, we still, at least from our vantage point, we still think it probably looks pretty consistent to what we were seeing at the onset of the year. Overall volume of wide releases, we're still counting at around 95 or so films, which is down a touch from last year's 110. again, relative to about 130 from pre-pandemic timeframes, and that's all a byproduct of the 6+ months of Hollywood strikes last year. So, as you mentioned, the year is definitely back-end loaded. More of that impact is playing through in the first part of the year, and then as you get towards the fourth quarter, that's when things really start to ramp up, particularly the scale of the releases, because those larger films that have more complex productions, more complex visual effects, like those are the things in particular that were most impacted. So I'd say at this stage, at least again from our vantage point, things we're seeing, we still think the year is kind of looking comparable to what we were anticipating 3 months ago. As we look out to 25, it's still a bit early per normal practice to try to get a full handle on that. We're optimistic that we're going to see overall volume. Our viewpoint was you saw a nice progression from 21 to 22, 22 to 23. Prior to the strikes, we were anticipating 24 would continue that trajectory, and then we had this little hiccup from the strikes. And we think 25 will likely spring back to that trajectory curve that we've been on of recovery. So it'll be somewhere likely in line or above 2023, between 2023 and pre-pandemic levels. Prior to the strikes, we thought there could be the potential for 25 or 26 to get back to pre-pandemic levels. With the strikes, we think that pushes out a little bit further. But again, we think that we'll see some nice lift in improvement next year once we're fully past the effects of the strikes of last year. And I just say, I know there's been a lot of questions on CinemaCon. At least the materials that were shared during that convention for the films that are going to be releasing in 25 look incredibly promising. I mean, we're really optimistic about what we saw and really pleased just with the quality of the presentation of those titles that are up and coming.
Mike, in terms of your question on domestic concession cost rate, the change that you saw year over year in Q1 was primarily driven by two key factors. One, a shift in product mix towards lower margin rate items, such as merchandise as well as candy. And then in addition to that, we did see some increases in the cost of some of our core concession items, so fountain beverages, bottled drinks, and candy. And then partially offsetting that was benefits that we realized from the strategic pricing actions that we've been implementing. As you look forward, we do expect concession costs as a percentage of concession revenue to begin to moderate over the next few quarters. Now, that said, we do still anticipate that our COGS rate will reflect a modest step up from full year 2023 levels, due in part to product mix as we continue to look to grow merchandise sales, expand enhanced food offerings, as well as scale third-party concession delivery, which have lower margins than our overall kind of core concession offerings. Now, while we do expect ongoing inflationary pressure to continue in 2024, particularly in transportation, packaging, and certain commodities, namely cocoa, we expect these pressures to be somewhat offset by corn, canola oil, and buttery topping prices moderating. So we also continue to execute on strategies to offset inflationary impacts wherever possible, including through strategic sourcing efforts or pricing strategies and proactive category management to really drive incidence.
Thanks, guys. Good luck.
Thanks, Mike.
Thank you. Next question comes from the line of Jim Goss with Barrington Research. Please go ahead.
Thank you. You discussed earlier a little your caution about new builds. I was also sort of interested in looking at the screen count reduction you've had over the past 5 years, I think, since pandemic. And I imagine the screen count reduction has had less of a revenue impact because of the nature of the screens you have been cutting out, and also less of a profit impact. But Can you talk about the headwind or drag that might have posed on you those years and what it's doing right now? And are you mostly through the process of screen count rationalization, or should we expect somewhat more?
Thanks, Jim. Good question. I'd say on the whole, the industry has probably seen slightly in excess of 10% screen rationalization since the pandemic. On a total net basis of those that we've closed relative to those that we've opened, we're slightly below that. Certainly in the U.S., I think we're about 7% or so of our screens down versus pre-pandemic. But the majority of those screens that have closed for us are ones that were lower performing screens. There were ones that were older theaters, more on the cusp of just break-even performance. So from an overall impact on financials, net between what we've closed and what we've opened, that's actually net positive in terms of bottom line. So I'd say we've been very, very particular in that. So there's been many theaters we've been able to go back and make modifications to leases and things like that and improve. And in certain cases, it just made sense to rationalize a bit. So, on the whole, that's just part of our overall optimization of our footprint as we're looking to really shore up our higher performing theaters, look to make modifications to those theaters where we have the opportunity to do so with certain leases where there's a bit of pressure, and then exit ones that are a bit more strained, in that whole calculus. And then, again, we're adding new theaters to those footprints where there's opportunity. As we look ahead, yes, I'd say we're kind of in that normal phase now where it was always part of our practice of, as older theaters are coming to the end of their leases, we're looking at how they're performing, and does it make sense to continue with those, or does it make sense to look to newer opportunities? So there could certainly be some incremental closures that we see over the coming years, but I wouldn't say that's necessarily a byproduct of the pandemic at this point. That's just more of our normal practice. And as I mentioned earlier, we have reinvigorated our development pipeline with regard to new builds and looking at new assets to bring into the fold. So that could also offset that.
Okay, and one other one. In recent calls, you've talked about alternative content, and it seems like it's a lot of the chains are talking about this a little bit more. I'm wondering what type of content are you thinking might resonate best with your audiences? Would it be concerts or sports if you can get the rights, or other smaller genres like the faith-based that you brought up? Are there other things? And also, IMAX and its call was talking about using other days, which seems to be the conventional wisdom as to when you might both net ahead with alternative content. Can you talk about any plans along those lines?
Sure. Look, definitely overall, we've been thrilled to see a burst of life with alternative content. Historically, it just kind of hovered around 1% to 2% of box office, and we always felt there was a lot more potential in these types of titles, and we're finally seeing that. For our circuit, I wouldn't say there's any one particular category that is necessarily a driver. It's really across the board. So you named a few of them, whether it be concerts, faith-based films, multicultural titles, anime. We're seeing great success across all of these different categories, and we're thrilled just to see more and more titles of significance coming into theaters in that area. Again, for the first quarter, non-traditional content represented about 14% of our box office, so it was definitely inflated again, similar to last year, which was a banner year for non-traditional films. So we're certainly leaning into that. I'd say the key is there's often work to be done in this space. So finding those types of products that lend themselves to scale. Sports, as you mentioned, is an area of opportunity. It's a complicated one just due to the way the licenses work. And then the question becomes, how can you get scale? Because those tend to be singular events on a singular showtime versus something like a concert or something like a faith-based film that can run throughout the week or weeks, really. There are some questions there. So it's all about finding those properties with scale. Looking for things that could be more unique opportunities to also fill in slower periods during the week. There's also the potential for that. I mean, we were talking about that earlier with some of the other kinds of event types of products that we bring into our theaters. So we'll have to see. But I do think what's been wonderful to see is, yes, the potential of these types of titles is being realized. What's also nice is that these types of films can also bring new types of audiences into theaters who then get exposed to the films, get exposed to the recliner seats, folks who may not have been in as frequently, and then they start a movie-going practice. So it can kind of expand beyond this type of content. So again, we remain really optimistic about continued growth in this space, and it really cuts across a range of categories.
All right. Thank you very much.
Thanks, Jim.
Thank you. Next question comes from the line of Stephen Laszczyk with Goldman Sachs. Please go ahead.
Hey, great. Thanks for taking the questions. Sean, you mentioned earlier the resilience you're seeing on the consumer front. Maybe just given that, could you update us on your latest thoughts on taking ticket price, especially from some of the more in-demand stretches of the slate coming up here over the next few quarters? And then one for Melissa, just on facility lease expense. Sean, I think you mentioned it in your prior response, but there might be some opportunity to negotiate on rent. I'm curious how much opportunity you think there is to move the needle there over the next few years. Thank you.
Okay, well, thanks for the question, Stephen. Look, I mean, the question on pricing is an important one. I mean, obviously, we were talking about the environment that we're in right now. So it's an area that we need to be careful about, and we are very careful about. We use a lot of data to drive our decision-making on what's the right price point. So while consumer resilience has certainly been there, demand has been strong, we got to be careful that we don't go too far and push things that could change that dynamic, right? Especially in a high inflationary type of environment where people may be starting to be a bit more discretion in what they select. We've seen that over the years. And again, we use a lot of data. We have a team that focuses heavily on this to make sure that we're trying to capture as much opportunity as we can, which basically cuts both ways. It's not unilaterally up. It can go both ways to really maximize attendance, maximize box office, maximize incidence with regard to food and beverage sales and overall food and beverage revenues. So again, it's something that we believe there's lots of ongoing opportunity with further analytics. It constantly is evolving, but it's a dynamic that we'll just continue to stay on top of, and it isn't unilaterally one way.
And then with respect to facility lease expense, so it's important to note that leases are contractual obligations, so unless there's an event such as the end of a lease term or a landlord needs our consent for their redevelopment, there isn't much of a catalyst to renegotiate a lease, particularly given the strength of our financial position. That said, we're actively working to renegotiate leases as their expiration and or renewal dates approach. And we have seen some success in that regard, particularly as it relates to more challenged theaters. But keep in mind that only about, call it 10 to 15% of our leases are up for renewal in any given year. So it's a fairly small percentage.
Great. Thank you both.
Thanks, Stephen.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to turn the floor over to Sean Gamble for closing comments.
Thank you, operator, and thank you all for joining this morning. I'd just like to emphasize again that we remain highly encouraged as we look ahead based on the current dynamics related to consumer moviegoing behavior, the different forward-looking indicators we see pertaining to film releases as we've discussed, and also just the wealth of opportunities that we see before us to drive incremental value creation. We do think that Cinemark is particularly well positioned to prosper on account of our advantage position and our exceptional team. And we look forward to speaking with you again following our second quarter results. So thanks again for the time this morning.
Thank you. This concludes today's
All right, let me stand this desk up because I've been sitting here since 4 a.m., so 4.5 hours already. Got to stretch my legs, and then we'll do a little Q&A. And then I got to make some breakfast. So if you don't want to listen back through a 1 hour live stream, I already put out this morning my Cinemark recap video. That's already out on the channel, 5 minutes or so, going over the highlights. Go check that out. A great quarter for Cinemark. IMAX also had a great quarter. When we contrast those to something like AMC, just keep in mind Cinemark and IMAX have great balance sheets. They're not upside down on their working capital. They're not upside down on liabilities versus assets. And they are both able to be profitable on a smaller box office. So when you're comparing, you must keep all of those things in mind. I think that based on what we know, current expectations for 2024 box office, Cinemark and IMAX should both perform strongly for the rest of this year because we expect every quarter to be better as we go through this year. The total box office going to be very similar to 2023, means that AMC most likely will not make a profit for the year. AMC needs box office over, by my best guess, over $10.1 billion to break even. So will that happen in 2025? We don't know yet. I keep on hearing all of these CEOs say the same thing. 2025 is expected to be better than 2023, but we don't know if it will be at pre-pandemic levels. So the movies are still dropping in. They're still jockeying for position in 2025. So we know it'll be better than this year. We don't know if it'll be big enough yet for AMC to book a profit. But everybody should be looking at a much better year in 2025 and 2026. So stay tuned. We'll be providing ongoing coverage of box office expectations as they come in. And that guidance on box office will get better from all these CEOs as we get further along this year. I think, if you're in AMC, I know there's a lot of very optimistic YouTubers and Twitter folks. I'm just going to keep it very real with you. I have realistic expectations for this year, meaning I'm not expecting any fireworks. I'm expecting that this year as a sum will be a loss for the company, but each quarter will be better than the one before. That's my expectations for AMC in terms of earnings. And we might have some profitable quarters. But things that I'm looking at, we got the dilution overhang. We got to get that dilution out of the way. We need some insight into the debt restructuring. I don't know when that's going to happen. Will it be this week? Will it be on the 8th? Will it be later this year? If interest rates go down, anybody's guess. But there's going to be some things weighing on AMC that these other companies don't have to deal with. So keep your expectations grounded in reality. Don't get overly pumped by people that are not really focusing on the negatives. I try and focus on everything. Am I optimistic about the industry? Yes, absolutely. Am I realistic about AMC's challenges? I am that as well. So you've got to manage your AMC position very intelligently, and I'm going to be trading it this year. There's going to be opportunities to make money. The people that are telling you just buy and hold, I don't know how you'll do on that. I will make money on this play because I'm going to hit the sell button in run-ups, and then on dips, I'll buy it back again. I'm also selling. I have a position in AMC right now. My total cost basis is well under $3. I will continue to sell covered calls on my position every week to lower that basis even further. I'm lowering it 15 to 20 cents a week by selling covered calls. Some weeks we haven't had that opportunity, but through smart timing, if you can time it great, you can lower your cost basis. Options is not for everybody. I'm not pushing options. I'm only telling you what I'm doing, how I'm staying ahead in this play. You do whatever works for you. I know there's a lot of people that get mad about people doing options trading, but I'm trying to manage my risk here. I'm trying to set myself up to have the lowest cost point so that if it runs up even to $4 or $5, that's 100% gain for me. We'll see. That's what I'm doing. Yeah, so I don't know, as we're in our little group talking about expectations, I got asked a bunch of times this week, what do you think is going to happen between now and earnings? I think, somewhere between 250 and 350 seems like a reasonable range for it to trade in based on what we're seeing from what the market's trying to do. They're not letting it run up because of all those overhangs that I just talked about. There's people willing to short it. It's cheap to short. It's easy to short. They're holding it down. So AMC is going to need to come through with some good news specific to AMC. Cinemark and IMAX can have all the good news in the world. That is not going to fix AMC's overhang issues, the dilution that's not done, and the debt restructuring. So AMC's got to have some breakthrough news, and then you get a chance, I think, for some good price push up if the news is good. So I'm right here with you trying to manage my risk and hope for that good news, and hope that it's not bad news. I think it's low probability bad news. I see the people just like you do saying reverse split and it's going to $1.50. I don't see the reason why any of that would happen, but I could be surprised. I'm not living my life thinking that this thing is going to reverse split or drop to $1.50. They'd have to have a torpedo of some news straight to the broadside for that to happen. Is it possible? Yeah, anything's possible. But I think those are low probability risks. So we will, as far as the AMC play, we will have to just wait for news. And hopefully Adam and Sean on the 8th have a very positive outlook like the CEO of IMAX and Cinemark did, and give some good guidance for the rest of this year. If you're looking for a safe play in the movie industry, well, obviously Cinemark and IMAX are it. If you're looking for a speculative bet that has high risk but potential for high reward, and I'm not talking short squeeze, I'm talking $2.60 to $5, $2.60 to $4. That's a pretty good reward. If you're sitting up there with the $80 cost average, I don't know what to tell you at this point. The price, if this company survives into 2025 and 2026 and starts having some profitable years, we're going to, if there's no more dilution after this one's done, you're going to see, based on potential profits, a price for AMC much higher than where it's at right now. How much higher? I don't know. It's going to depend on earnings per share. But what, 10, 12, 20 bucks if they had 50 cents or $1 annual earnings. All of that, guys, is just a bet on box office. I can't tell you what it's going to go to because I got to see the box office. Got to see the box office in 2025, 2026. If you start having an 11 or 12 billion domestic box office where every AMC location can crank out a profit, the whole game changes. And the amount of debt, you hear people saying the debt. The amount of debt is irrelevant. As long as they get it pushed out, if they can crank out a profit and free cash flow, the whole game changes for what could happen with the price of this stock. That's my view anyways. So we will continue to provide you here the best non-emotional, non-crybaby, and also non-hopium view of the facts, the financials, the risks, and the potential benefits. I'm going to continue to say, for me, this year remains a speculative bet. It's a risky trade, but you guys have known that since day one. As the OGs told us back in the day before I ever came along, don't invest what you're not willing to lose in any non-profitable speculative play. If you keep that in mind, then you can sleep at night. I'll provide a update at the end of this week on how I traded this week. I'm trying not to, on YouTube discuss my trading because I don't want to influence people, but I have been publishing weekly recaps of what I did. I publish them daily in the Discord. But for the YouTube audience, because of all these the crybaby idiots out there looking to blame other people, I'm just not doing that much AMC coverage. You can go blame them for that. I don't need to deal with all that stuff. But I'm still in this play just like you guys, and I'm doing okay. Let's see. Any other questions for the morning? Brazil, AA, good morning to you. Richie Rich, good morning. Headstock Karam, good morning. Diatog, good morning to you. Richie says Olympics in the theaters next quarter may give a bump up. I'm very curious about that. I'm very curious. I have become less of an Olympic watcher, but I know that there are plenty of people that are interested in watching them. I still have it on my list to go watch a MMA fight. And speaking of movies, I watched the early screening of The Fall Guy with Ryan Gosling and Emily Blunt last night at AMC and IMAX. And I will say that I left that movie with a big smile on my face. As it was starting out, it's a 2-hour movie. As it was starting out, it started for me a little bit slow. But if you saw my review on Twitter last night, I kind of realized that they did it like a 4th of July fireworks show. They got you hooked, they got you interested, and then they just started amping up the level of action and stunt. And it's just a fun, good time. If you're a movie lover, if you're a fan of stunts, just about every single possible one was in there in spades. And they got bigger and better. And I saw some fun stunts in there that I've never seen before. Some fight sequences I've never seen before. It's a lighthearted movie. I watched Lee Majors back in the day in the 70s and the $6 Million Man and the 80s and The Fall Guy. And he has a cameo in this movie, which was just like, And they ended the movie with some bonus footage and the theme song to the original Fall Guy, which I really appreciated. I was not super excited to see in my early screening that the theater was not full. A lot of them that I go to, it's packed, like Dune 2, obviously. So that was disappointing. I don't know if there's not a lot of buzz, and there's probably not a lot of old people like me that remember, what is the Fall Guy? You had to be watching TV and enjoying action shows like Dukes of Hazzard and The Fall Guy in the 80s to really be excited about this one, I think. But I hope that the momentum builds for it. It is an enjoyable movie. So go see it. Support your investment. Stop listening to these crybabies that say boycott AMC. What the heck? What the heck is wrong with people? Headstock Harem says, I don't think AMC is near bankruptcy now, but is there a time frame for that possibly? Yeah, good question. So in their latest 10K, they said that there is no going concern risk. And if you look at the credit report agencies from Moody's or S&P, they also say no immediate bankruptcy risk. Immediate in the finance world means next 12 months. Ongoing concern statement covers next 12 months. So we feel pretty confident, comfortable that over the next 12 months, there is little to no bankruptcy risk. The company had $880 million before Q1. We know that they spent some of that money in Q1, dropped it down to $660 million or so, but they're raising $250 million to get back up to that level. As the box office improves this year, that cash burn we had in Q1 for AMC should decrease. If a quarter is good enough, maybe they add a little cash later this year. I don't know. We'll have to see. But a company with $600-800 million that's making its interest payments, even if they're breaking even towards the end of this year, that you're not in bankruptcy risk. So to answer your question, the thing I need to see to say we made it is I need to see that the lenders are willing to work with AMC to push the debt out. And the other thought that I have on that topic is no one wants to talk about more dilution, but remember, even after this $250 million is done, they still have over 200 million shares that they could sell. That's kind of like their get out of jail free card. So if they feel like they're running low on cash, depending on what the price is at, they would be, I would think, likely to try and sell some more shares. I just don't think that is a high probability event unless they're forced into doing it by the lenders as part of a debt restructuring. 800 million should be plenty enough to get them into a better 2025. And I just don't think that we're going to see $260 million cash burn quarters every quarter through this year. I will end that discussion by saying what I've said every month this year. The two things that I am watching most critically is cash balance and cash burn. And how do I measure that? By box office and my spreadsheet. So I will, in June, just like I did in March, I was very lucky. I was watching the box office. I was forecasting cash burn on my spreadsheet in the Discord, giving people about a week's heads up that I thought a dilution was coming and that I was going to sell my shares. And I did on March 27th, I think was the day. Or maybe the 28th. It was right before they announced the dilution. I was like, guys, they're going to need to raise cash. So I avoided that drop and preserved my capital and bought back in when it fell under $3. I will be doing the same thing for myself, for my Discord in June. And hopefully, the box office in Q2 is enough that we don't have to worry about it. But I'll try and do better on YouTube and let y'all know. I just don't like dealing with all the negativity. Can you imagine how many freaking bullets I would have got in the back if I would have told you guys on YouTube March 27th, they're going to dilute, I'm selling. And what if I was wrong? I acted on my own DD like I always do, but what if I was wrong? And I said that on YouTube. I don't like leading people into making bad decisions, and is for Q2. It's just too early right now. April was a bad month. We knew it was going to be bad. May gets better. June's supposed to be even better. So we'll see. If box office is over 2 billion, 2.2 billion, I don't think we have anything to worry about for major cash burn. So cross your fingers, go see some movies, buy some popcorn, and support your company. Longer term headstock harem, if we make it through this year, bankruptcy risk for AMC, if they get a debt restructuring and they make it through this year, things get a lot more positive into 2025 and 2026. But it's got to, for AMC, the way it's sized right now, we got to have we got to have the annual box office over 10.1 billion. We just have to. And if that doesn't happen, then the company's going to have a come to Jesus moment. They're going to have to, cut costs, jettison something, sell Odeon, file bankruptcy. I don't know. There's a lot of different ways it could go. I'm sure they're planning multiple scenarios, and they're crossing their fingers and praying to baby Jesus that the box office recovers, because they will do fine if the box office increases. They're, as Adam has said, survive, then thrive. They've told you their plan. They're trying to survive until box office improves. It remains to be seen how the box office goes. So that's up to Hollywood. AMC is clearly not telling us we're going to cut to survive. They're not saying that. So that's why it's incumbent on me, you, all of us, to pay attention to what's going on, pay attention to what they're saying. Survive could mean more dilution. I don't know. But listen to what management's saying. Stop listening to people that aren't giving you good info, whether it's hopium pushing or the crybabies. Listen to what management is saying. Look at the financial statements. Logic is boring, but it's not going to lead you astray. Numbers are not going to lead you astray. And management is not allowed to lie to you. They've been very transparent that their strategy is to repair the balance sheet. Survive, then thrive. There's only a couple ways to fix the balance sheet, guys. Pay down debt, raise cash, or increase revenues. That's about it. And how do you pay down debt? Well, you got to increase revenues or raise cash. Only a couple buttons to push here. Pay attention. Pay attention to the financials. Stay tuned in here, and we'll provide you maybe the news you don't want to hear, but the real fucking news. Diatog says, if I were a lender and I thought AMC would be able to continue to operate into the future, I'd renew my loan. I would do the same thing, Diatog. That's why I think the bankruptcy risk, or the people saying the lenders want to bankrupt this company, just like, what are you smoking, guys? What are these people smoking to come up with that? Now, gosh, I'm going to look stupid if they end up filing bankruptcy this year because a lender wasn't willing to play ball. But why would they come this far through all of the freaking trials and tribulations of the last 3 years? Why would the lenders do that and then just say we give up right on the cusp of victory? It does not make logical sense unless you're a conspiracy theorist. And we've clearly identified now who the conspiracy theorists and the emotional investors are. They've identified themselves very clearly. If you hear people say that, they're not looking at the financials. They're not thinking like a normal person. They're thinking this is all a setup. Capitalism does not work that way. Mediocre trader, what's going on, amigo? Frank Esposito, good morning. Michael, good morning. Hedge funds win with bankruptcy, not lenders. Yeah, nobody wins in AMC, guys, with bankruptcy. There will be no winners. AMC doesn't own real estate. It doesn't have any assets. Tell me the frickin' plan of why someone would purposely bankrupt this company. Nobody wins. You got a bunch of unsecured second lien holders that will get zero recovery or pennies on the dollar. It makes zero frickin' sense. All these people pushing the conspiracy bullshit. Sick of them. Just they're lost. They're emotionally lost. And unfortunately, a lot of them are making really bad decisions right now, buying puts because they think it's going down to $1.50. We're over here making money. Just learn to read the financial statements and analyze this play like a normal person. It's not hard. Sparky says lenders don't want to bankrupt the company. They get almost nothing, but the 10% 2026 bonds trade at 75 cents. It's not going to be an easy roll. They will want more equity raised, I think, quite possibly. I know Sparky, welcome. Sparky gets beat up on a lot in my comments, but guys, I will tell you, even though he, much like me, doesn't tell you always what you want to hear. I think he has a very reasonable and knowledgeable approach to his comments. So I think it's good for you guys to listen to someone that's maybe not feeding you those big old spoonfuls of opium. We don't know how the debt restructuring is going to go. And I've said that if you've been listening to my live streams or my videos, as a long shareholder, even with my cost average well below $3, the number one thing that would keep me up at night, and I'm not over leveraged in this play, like I don't have my whole life savings in AMC, but I have a substantial amount. The number one thing that would keep me up, even with my low cost basis, is some news that I don't want to hear in the debt restructuring. It's going to be convertible notes, or we're gonna need to trade $200 million in equity in order to get the debt restructuring done. Like I just don't know. It's a big unknown, and I don't like that. So I'm trying to manage my risk as best I can, knowing that it's a speculative play. How do I know it's a speculative play? There's 5 pages of risk factors for you to go read in every 10Q and 10K. And the company's not profitable. Until those things change, it's a speculative play. So play it accordingly, play it smart, play it safe. Careful what you do. And I wish everybody luck. I'll be right there with you if we get some good news. I'll be right there with you. And if we get some bad news, I will be selling. I'll tell you that. All right, ladies and gentlemen, I'm going to go get some breakfast. I will see all of you in the Discord here in a few minutes. I got to refill my coffee. Thanks for tuning in to the Cinemark live stream. If you don't want to rewatch that, I already have the recap out there for you. And we got a lot of other stuff to talk about. I'll try and get some other videos out later today and the rest of this week, and we'll see if we can get an evening live stream set up for those of you that are not the early risers. So thank you one and all. We will see you on the next one. Appreciate your time.
So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a